Most analysts look only at price. Some look at volume. But almost no one looks at time. Yet time is the missing variable that explains why markets behave the way they do. What you see on the charts right now is directly connected to the mathematics of chaos, and especially to something called a bifurcation. A bifurcation is the moment when a dynamical system changes its behavior and splits into two possible outcomes. In the logistic bifurcation diagram shown on the screen, you're seeing how a simple equation transitions from stable behavior to period doubling and eventually to chaos. And the remarkable thing is this: the spacing between those bifurcations shrinks at a universal rate. The Feigenbaum constant, approximately 4.66. Now look at the price chart. Every move in the market creates a time pulse, a stretch of time during which price moves consistently in one direction. On the chart, this pulse is marked as T, the duration of the initial move. This is where chaos meets market structure. If you take that pulse length T and project it forward in time, then multiply it by approximately 4.66, you find a window where the market almost always reacts. Sometimes the reaction is a continuation. Sometimes it's a sharp reversal. But it is rarely nothing, because the system reaches its own bifurcation point. When you observe the first chart on the screen, you see a strong move, the initial pulse T. When we move forward 4.66 times that duration, a significant reaction appears exactly in that window. The system chooses its next path, just like in the logistic map. In the second chart, you see the same behavior repeating. A new pulse, a new T, and once again, around 4.66 T. The system reaches a decision point, a time bifurcation. The connection becomes clear when you compare it to the logistic map displayed beside it. Identical ratios, identical structure, identical dynamic behavior. Just as the logistic map accumulates tension until it reaches the next bifurcation, the market accumulates tension through time until it reaches 4.66 T. That is the moment where the internal dynamics force a resolution. And the vertical reference lines shown on the bifurcation diagram, 0, 0.5, 1, and especially the spacing leading to 4.66, correspond directly to the timing structure measured on the price chart. The market behaves not only as a sequence of trades, but as a true chaotic system. So when you look at the charts presented, what appears to be unpredictable timing becomes understandable. The market is following the same universal principles that govern chaotic systems. A pulse is created, time accumulates, and around 4.66 times that pulse, the system is forced into a bifurcation, a decisive moment of continuation or reversal. This is why the pattern repeats. This is why it is measurable. And this is why time, not price, is often the key to understanding market structure.